Topic examines the methods investors use to access alternative investments and the structures through which these investments are offered. The program explains that alternative investments are typically less standardized and less liquid than traditional investments, requiring specialized access mechanisms and investment vehicles. Common structures include private funds, liquid alternatives, direct investments, and co-investment arrangements. Each approach differs in terms of liquidity, governance, transparency, operational complexity, and investor control. Institutional investors often select access methods based on investment objectives, risk tolerance, available expertise, and capital constraints. Understanding how alternative investments are accessed is essential for evaluating portfolio construction, risk management, and long-term investment strategy implementation. A major focus of topic is the structure of alternative investment funds. Many hedge funds, private equity funds, and private debt funds are organized as limited partnerships in which the general partner manages investments and limited partners contribute capital. Investors commit capital for extended periods because alternative assets are often illiquid and require long investment horizons. The program explains that fund terms may include lockup periods, redemption restrictions, capital calls, carried interest, and management fees. These features align incentives between investors and managers but may also reduce liquidity and increase operational complexity. Proper understanding of fund structures helps investors evaluate risk exposure, fee arrangements, governance rights, and expected investment outcomes. The program also discusses liquid alternatives, which provide investors with access to alternative strategies through more liquid and regulated investment vehicles. Liquid alternatives often use mutual fund or exchange-traded fund structures to offer hedge fund-like strategies with greater transparency and easier redemption terms. These products may employ strategies such as long-short equity, managed futures, market-neutral investing, or global macro investing while maintaining daily or periodic liquidity. Liquid alternatives have become increasingly popular because they allow retail and institutional investors to access diversification benefits without committing capital for extended periods. However, the program notes that liquidity requirements and regulatory constraints may limit strategy flexibility and reduce potential returns compared with traditional private alternative investment funds. Direct investment represents another important method of accessing alternative investments. Through direct investing, institutions or wealthy investors acquire ownership interests in private companies, real estate projects, infrastructure assets, or other specialized investments without using external fund managers. Direct investment provides greater control over investment decisions, governance, and operational oversight while potentially reducing management fees and carried interest expenses. However, the program emphasizes that direct investing requires substantial expertise, resources, due diligence capabilities, and operational infrastructure. Investors must independently evaluate opportunities, manage risks, and oversee asset operations. Because of these requirements, direct investments are generally more common among large institutional investors with specialized internal investment teams and extensive market experience. Topic also highlights co-investment opportunities, which allow investors to participate directly alongside private equity sponsors or lead investors in specific transactions. Co-investments can improve portfolio diversification, increase exposure to attractive opportunities, and reduce fee burdens because they often involve lower management fees and carried interest. Institutional investors frequently use co-investments to strengthen relationships with fund managers and gain greater control over portfolio construction. However, co-investments also present challenges related to due diligence, transaction speed, concentration risk, and resource requirements. The program explains that successful co-investing requires strong analytical capabilities, governance processes, and operational coordination. Historical evidence suggests that co-investments may improve returns when managed effectively within diversified institutional portfolios. Finally, topic emphasizes the importance of selecting appropriate access methods based on investor objectives, resources, and risk tolerance. Different investment structures offer varying degrees of liquidity, transparency, control, fee efficiency, and operational complexity. Institutional investors must balance the benefits of diversification and enhanced return potential against challenges such as illiquidity, valuation uncertainty, leverage, and governance risk. The program reinforces that alternative investments require specialized expertise and thorough due diligence to evaluate managers, structures, legal arrangements, and operational risks effectively. As alternative investment markets continue to expand globally, understanding access methods becomes increasingly important for portfolio construction and long-term strategic asset allocation. Effective access decisions can significantly influence investment performance, risk exposure, and operational success.